Warren Buffett on CNBC radio recently said, I'd buy up a couple of 100,000 single family homes if I could. Now, here is Warren Buffett, our guru and mentor. There's no investment advisor better than Warren Buffett. He can help you to create wealth, as he has done for so many others. In a recent interview at CNBC Radio, he said, I would buy up a couple of 100,000 single family homes if I could. After those comments, very big institutional investors started scooping up large numbers of homes to profit from them. Now, with very little of your money, you too can participate in these big profits by using bank financed, well managed Florida rental homes and create wealth for yourself. Here is a brief presentation. Let's explore the features of an RRSP and see how we can double the assets, the income, and what is left in the estate. So, Ray Lawrence and Carmen De Silva, CA, CPA, are asking you, without spending a penny out of pocket, would you like to take advantage of withdrawals from RRSP and not pay the taxes? Would you like to more than double your assets within 1 year? More than double your income from 2014 onwards, and finally to more than double the assets that you will leave to your heirs. Let's take this example of the RRSP, which has $25,000, and see how we can double that within a year and double the annual income and double what's left in the estate. So we have proposed that you withdraw $4,000 a year from the RRSP. So we get a line of credit and open an account outside of the RRSP of $100,000 to invest. Now, though this $4,000 withdrawn from the RRSP is taxable, the interest paid for the $100,000, which is about $4,000, is tax deductible. So that makes your withdrawal from the RRSP tax free. The RRSP could be earning in some mutual fund 5%. It could be even losing money. We don't know. But let's assume it earns about 5%. On this open account, the 100,000 line of credit could be invested in US real estate to earn 14%. Now, if it earns 14%, the income from this open account is $14,000 a year compared to the RRSP, which is a growth or income of $1,200 a year. At retirement, the RRSP has an income. This $14,000 can be our income that you could use today. And finally, when your RRSP, when you die, 100% of the assets in the RRSP are taxable. So what's left to the heirs from the $25,000 would be $12,500. On the other hand, the open account, if it's invested in real estate, the tax on properties is 50% of the gain is taxable. It's something called capital gains tax. So 50% of 100,000 is 50,000. That is taxable. Let's say the tax on the 50,000 is 25,000. So what's left over from the 100,000 after paying the tax is 75,000. So not only you've more than doubled your RRSP, you've more than doubled the income from that RRSP today, and you more than doubled what will be left over to your heirs. Now, this real estate that we're talking about is something that Warren Buffett has endorsed in a recent interview at CNBC. So, backing up to our questions, would you spend a penny without spending a penny out of pocket, have we done what we said we could do? In other words, withdraw from the RRSP and not pay taxes. Doubled your asset within a year, more than doubled. In fact, in this example, you quadrupled your assets. And again, more than doubled your income in 2014. In this case, we have more than quadrupled that income. And finally, more than doubled your assets left to your heirs. We have more than quadrupled that. So if you look at the two scenarios, how quickly would you like to establish an open account using your RRSP? Now, you may have more than 25,000 in your RRSP, you may have less. Would you want a free calculation of your RRSP income from 2014 onwards? If you would like this free calculation, send us your RRSP amount, your full name, email address, and cell phone. Send it to jthomas at 416-829-6904. Thank you.